Good morning. Thank you for joining us at Capstone Coffee Conversation. My name is Ryan Skogstad, and I thought today that we would just kind of go through a little recap. We're almost halfway through the year of 2023. A little recap of where markets stand today, what has worked, maybe what hasn't, and then also just talk a little bit about our thoughts and positioning and why we are positioned the way we are. So we'll just get right into it. And then if you have questions, please just message to the host any questions, and we'll try to cover those at the end. But I've got a lot of little notes here. We'll kind of bounce around a little bit, but if you have a question, send it in, and then we'll hit those at the end. So a little recap so far this year. Stock market have been pretty much as expected. Not a lot of surprises, generally positive, slow progress for the most part. And interest rates have remained mostly unchanged for the year. There have been some ups and downs in interest rates as we've moved through the first 6 months, but we stand today pretty much where we started the year with interest rates. So slow progress in general for stocks, interest rates being pretty status quo so far for the first 6 months. Certain particular stocks, though, have far exceeded expectations. So we'll talk about that for a second and give you a little breakdown. So the S&P 500 today, so 500 biggest companies in the country, up 13% year to date. That has exceeded expectations. We'll talk about that. 13% is a great number through 5.5 months. We're not even at the 6-month point yet. The equal weight index, though, the equal weight index of the S&P 500 is up 4%. Okay, so equal weight index is up 4, S&P is up 13. Small caps are up about 5% so far this year. International is up 11, so that's a good number for international. Emerging markets are up about 6% so far year to date, and the bond index is up about 2. Okay, so let's kind of break that down a little bit and talk about the difference between the S&P 500 and the equal weight index. So the equal weight index means give me an equal weight of every stock in the S&P 500. So each individual position, you buy the same amount of dollar value at. Okay, so the equal weight index is up 4%, meaning if I just own one of everything, then I'm up 4% for the year. The S&P 500, in contrast to the equal weight index, is a market weight index. So that then would say Apple is the #1 market cap company in the country. So Apple gets 8% of my money, which is about what it gets today. And Microsoft, which is the #2 company, gets about 7% of my money. And Amazon, the #3, gets about 3%. NVIDIA, which is the #4 company today by market weight, also gets 3%. And so you get 8% or 7% and 3%. And the 500th company gets fractional pieces of your money, just very small percentages. So equal weight, give me one of everything, everything equal. Market weight is based on size of company. That's how much dollars of your investment they get. So you can tell with the S&P 500 market weight index being up 13 and the equal weight index being only up 4, the top few companies in the S&P 500 are doing very well when the general stock market is very slow so far this year, if that makes sense. Okay. So why is that so far? And that's I think what's kind of exceeded our expectations. The term artificial intelligence is getting thrown around quite a bit today. And so those top handful of technology companies, Microsoft, Apple, Amazon, Google, NVIDIA, those companies, which all make up the top 5, and I think Meta's up there as well, Facebook, those companies that make up the top biggest portions of the S&P 500 are all in that artificial intelligence space. And just throwing out that word today is driving stock prices for this first half of this year to lofty, very lofty levels, we would say. So that's been good because we see markets in general going up. But the staying power, let's discuss. Whenever we start to see a new fad, I don't think artificial intelligence is a fad. That's probably a bad word. It's going to be here. It's staying here. It's not going away. But it's a fad in investment terms right now, I feel. Okay? Whenever we see a new fad, a lot of times people will chase that. And then at the end of that becomes some difficulties. So I'll give you a couple stats. Artificial intelligence was mentioned 168 times on the first quarter earning calls of Meta, which is Facebook, Alphabet, Google, Microsoft, and Amazon. So those four companies in their first quarter earning call mentioned artificial intelligence 168 times. It is definitely going to change their business, change efficiency, change how we do things. That will definitely happen. But does that mean that stock prices all of a sudden should have valuations change? We might argue no, but so far they have. Case in point of times that we've seen new technologies drive the stock market maybe to sometimes irrational numbers, only to have a crash later. The dot-com bubble in the late 90s, anything with the dot-com after its name went to valuations that were far exceeded the market, only to be followed by a large crash. Marijuana stocks, when marijuana stocks came to the marketplace, everybody was for certain that you can't lose money in marijuana. And lo and behold, I don't think stock prices have ever made money in marijuana stocks. Solar power, everybody's going to have solar, it's new energy. Solar powers have done nothing but lose money in the markets for the most part. And then even Tesla. Tesla did very well, great story, but its stock price has come way down off its lofty levels. So just because something is a new technology and yes, has staying power, sometimes chasing those stocks to lofty valuations can in the long run be difficult to duplicate. And so that's something that we would say, but so far this year, artificial intelligence has dominated the investing nomenclature, and we are discussing it a lot. And we have seen some run up in some big technology stocks. And so that's been good and helpful as far as at least driving up the index. But for the most part, markets in general have behaved as expected, making slow progress this year. So as we see the market today, is in total, so S&P 500, the S&P 500 today is trading at 19 times earnings. So when we look at like, well, is the stock market cheap? Is it expensive? Where's it going? I think one of the best ways to kind of view a long-term picture of that is, well, what are we paying? What are we paying for stocks today relative to what we've paid for them historically? Trading in the short run on valuation can be very difficult because a lot of times stocks don't move in the short run on PE, right? That's a little bit too simplistic. But in the long run, what you pay for stuff matters. Okay, so today's stock market's trading at about 19 times earnings. The large growth or the kind of the tech side of the stock market today is about 36% overvalued on current typical valuations for the last 20 years. So in other words, if I said it's at if it's level, then we're getting normal prices, but it's 36% above typical average valuation prices. So if you're buying those large tech names, you need a lot of things to go really well, almost perfectly, for that to do well for you over time, because they're about 36% overvalued. The value side of the market, so the areas of the stock market that really doesn't have any tech, kind of deals with maybe some energy and financials and things of that nature, that's about 4% overvalued. Okay, so the large growth, big tech names, if history would play out, they're about 36% overvalued today. The value side of the market's about 4% overvalued today, but both are overvalued, right? The stock market, again, trading at about 19 times earnings. Historically, stock market trades at about 17 times earnings, right? When the stock market gets to 20, that's getting pretty rich. And so today, as we look at it in total, it is not an area of immense opportunity. It is an area that we would say tread carefully a little bit. So how does the stock market get to a place where it is at normal valuations, right? So if it's at 19 today in general and 17 is typical, well, there's three ways to fix it. Number one, the economy does very well and companies start earning more money. If companies start earning more money than expected, then that helps the stock price because, okay, they're doing better than expected. Well, the valuation was higher than normal. Well, that's okay because companies do better than expected. So the economy either needs to do really well. That's one way it could get fixed. Second way is interest rates come down. Okay, so if interest rates come down, costs get less, people can spend more, that helps the economy. So interest rates coming down would be a second way to fix valuation questions. Or the third way to fix valuation questions is stocks either stall or fall and kind of let things catch up, right? Let's talk about each of those. So is the economy going to do very well, right? That's kind of this artificial intelligence run up is this is going to change everything and stocks are going to earn a lot more than expected. So is the economy going to do very well? Our base case, our kind of default case is we are prepared for some type of recession at some point. I know it's been the most talked about recession. It keeps coming in 3 to 6 months. And so who knows when that comes, but we do see some type of recession at some point. We are 13 months today, we're 13 months in to a yield curve inversion. So let me explain what that means. A yield curve inversion means today, for instance, we're getting paid 4.6% on a 2-year treasury. If I put my money in a 2-year treasury, we get 4.6. If I put my money in a 10-year treasury, I get 3.8. That is opposite of how it's supposed to work. Typically, if I tie my money up for longer, I should get paid more. Today, 4.6 on a 2-year, 3.8 on a 10-year. That's upside down. So typically it should be more on a 10-year than a 2-year. That's what we call a yield curve inversion. Whenever a yield curve inversion happens, we almost always see a recession 12 to 18 months later. So we're 13 months into a yield curve inversion. So a recession could be imminent. It could be a handful of months down the road. It could even be 7 months down the road, but we're somewhat prepared for some type of recession because the yield curve on the bond market is telling us that it's coming, right? And that basically means the long-term economy is not expected to do as well as the short-term, and that is an upside down picture, okay? So is the economy going to do very well and grow into that 19 times earnings? Our argument would be to be cautious there. Right? That wouldn't be a greater than 50% scenario for us. Is the Fed going to is the Fed going to lower interest rates? That's the second way we can grow into those valuations if interest rates come down. The Fed has been very transparent and kind of trying to target 2% as their inflation target. Today, inflation's at 5, or 4.9. That's much better than it was at 9.3 a year ago-ish today. So 5 is better than 9. We all can agree on that. But the Fed sees 5, and that's much higher than 2. So even if the economy slows, we don't see the Fed definitely not cutting rates. They're probably going to have to keep rates higher for longer than the market wants to get inflation down to 2%. That's a big target, and they have not come off that target. It's a low target, not a big target. It's a very low target, and they've stuck to that. So that's going to be hard to get there with the market expecting rates to go down. So we would think interest rates are going to stay level for quite a while, longer than expected, maybe even tick up again. And the Fed actually meets tomorrow. So then the third way that a 19 times earnings or a slightly expensive stock market fixes itself is stocks start to stall or fall. And so I think that is our base case, is to try to lean the portfolio towards the areas that aren't expensive, because the areas that get run up the most or become the most expensive are the areas that get hit the hardest if we have a stall out or a slight fall in stocks. Okay. And we've kind of already seen that. Stocks in general, without the artificial intelligence names kind of being in the market, stocks in general have been just slightly positive this year, the equal weight index being up 4. We would see that grind continuing and trying to be slightly cautious. Investing, I kind of wrote in here, investing is a game of probabilities. Anybody that tells you here's what's going to happen and we know it, you should probably run from as fast as you can. All you can do is try to create probabilities on what's the most likely scenario, and then create an allocation that aligns with those probabilities, right? So even if we think, hey, a recession's coming at some point, we don't know, right? We want to be very diversified. We want to have our toes in lots of different buckets, but the probability is definitely there. So we're going to lean a portfolio towards those probabilities. We also try to go to where there's historical value in stocks or bonds or what have you. And so when things are grossly expensive, we try to make sure that we're not chasing and adding to areas that don't show value historically. History might not repeat itself, but it rhymes. And so a lot of times things can go a little bit longer or shorter than you would expect, but many times you'll see the same story play out. So today in our investment strategies, the words that I keep kind of finding myself saying is be cautious, but not scared. So we're trying to be careful as we allocate portfolios, making sure to not take on too much valuation risk. And so being cautious, but not scared. Okay. We're getting paid still for bonds today. Bonds are paying us to sit and have a little slight cautious stance. They're earning interest rates higher than we've seen in 2 decades, almost a decade and a half. So we're getting paid for fixed income while we wait and be slightly cautious. We try to stay away from the word FOMO, fear of missing out. And I think that's where times a lot of people get hurt in investing is they get FOMO and they see, hey, this has done well, or I'm missing out on something. And over time, you're probably not. But in the short run, we try to make sure that we stay away from FOMO, fear of missing out, as some things have actually definitely run up and done very well. We participated in that, but we want to make sure that we are in valuations that make sense for a risk-reward perspective over time. Sometimes irrationality can move much longer and farther than we expect, and that happens to the upside and the downside. 2008 financial crisis, market kept going down and down and down to prices that were dirt cheap. Companies were selling for less than they could sell the building for and close the books, and that made no sense. But they kept going down anyway. So on the downside that happens, but then also on the upside, again, some of these things that have driven the market up have only just started to be discussed, and there is no proof in the pudding yet. So sometimes they can run up much farther and faster than we would think, and same thing on the downside. We want to make sure that we stay disciplined to a process, investing in what we see as the best probability. And today, slightly cautious, leaning towards value, and being disciplined in that way. Okay. I've been chatting a little bit. I hope that is resonating with you. And those are some of the conversations that I know that I have with you and that our teams have with you individually. But are there any questions, Kennedy, right now? No? All right. If you do have any questions that you just didn't want to send in, please feel free to get in touch with your advisor, give us a call, shoot us an email, and we can talk about any of these points that we've talked about or anything else as well. Well, thank you for joining us on Capstone Coffee Conversation, and we look forward to seeing you next month.